Welcome to Explain the Charts. I am your host. Today is Wednesday, March 25th, 2026, and we are diving deep into the AUDUSD currency pair. The markets are currently navigating a minefield of geopolitical risks and central bank divergence. Before we look at the charts, let's talk about the headlines driving the Aussie dollar right now. Geopolitical tensions in the Middle East, particularly regarding the Strait of Hormuz, are the primary driver of volatility. There are conflicting reports about a potential ceasefire between the US and Iran, which has kept traders on edge. Safe haven demand is supporting the US dollar, while the Australian dollar is feeling the weight of risk aversion. Domestically, the Reserve Bank of Australia remains hawkish with a cash rate of 4.1%. However, cooling CPI data at 3.7% has led some to question the RBA's next move in May. Let's start with the daily chart to see how these events have manifested in price action. Looking at the daily candles specifically for early 2026, we can see a clear uptrend that characterized the start of the year. The pair reached a significant peak near 0.7120 in mid-March, which aligns with the RBA's recent 25 basis point hike. Since then, we have seen a sharp reversal as the geopolitical risk premium was aggressively priced into the US dollar. Note the consecutive red candles leading down to the 0.6980 level, where we are currently consolidating. This pullback represents a drop of over 200 pips from the monthly high, showing how sentiment can shift rapidly. Analysts are divided on whether this is a simple correction or the start of a deeper bearish slide. A break below the 200-period exponential moving average has many technical traders shifting their bias. Support around 0.6950 is being tested as we speak, and its holding is crucial for any bullish recovery. If this level fails, the next logical target for bears is the 0.6835 zone, which we haven't seen in months. On the other hand, the RBA's hawkish stance provides a fundamental floor that prevents a total collapse. China's economic stabilization efforts also play a key role, as they remain Australia's largest trading partner. The 10-day correlation with crude oil has turned sharply negative, which is quite unusual for the Aussie. This suggests that war risk is currently more important to the market than commodity-driven growth. Investors are clearly prioritizing safety over yield in this highly uncertain global environment. Now let's drop down to the 1-hour chart to analyze the recent range in much finer detail. On the 1-hour time frame, we can see the granular nature of the recent sell-off throughout March. Notice how price action became trapped between 0.6955 and 0.7011 over the last several sessions. This range-bound behavior reflects the market's complete indecision regarding the US-Iran situation. Every headline about a potential ceasefire leads to a temporary spike, while new threats cause a sell-off. We saw a notable drop on March 23rd that walloped both sides of the bid and tested the lower bounds. The 1-hour candles show significant volume spikes during these specific periods of high volatility. Resistance at 0.7030 has proven to be a very tough nut to crack for the bulls in the short term. Each time the price approaches 0.7000, selling pressure from institutional desks seems to intensify. From a short-term perspective, the bears have the upper hand as long as we stay below 0.7000. Technical indicators like the MACD and RSI are showing a bearish bias, though RSI is nearing oversold territory. This could signal a temporary bounce if no new negative geopolitical news hits the wires tonight. Traders should watch for a definitive breakout from this 0.6955 to 0.7011 corridor to confirm a move. A move above 0.7011 could lead to a quick test of the 0.7085 hurdle, which previously acted as support. Conversely, a sustained move below 0.6950 would likely trigger a wave of algorithmic stop-loss selling. Market strategist Janam Mehta points out that retail dip buying at 0.7000 may be setting up a stop hunt. This means we might see a fake-out move lower to flush out weak longs before any real recovery occurs. High-frequency traders are likely feasting on this intraday volatility, while longer-term players wait. Resilient domestic data in Australia is fighting against the global tide of risk aversion. The RBA's narrow 5-4 vote for the last hike shows that policy is reaching its limits. Let's look at the 15-minute chart to see the most recent price movements from the last 48 hours. The 15-minute chart shows the microstructure of the market as we approached today's session. We can clearly see the price action around the time of the terrible 2-year Treasury auction. That auction saw the biggest tail in 3 years, which spiked U.S. yields and immediately pressured the Aussie. Notice the sharp dip on the chart during that specific event on March 24th. Also, observe the minor recovery when President Trump mentioned a pause on military attacks on Iranian plants. These headline spikes make it extremely difficult to trade with high leverage right now. The price literally whipped from 0.6980 back to 0.7000 in a matter of minutes multiple times. For day traders, these levels at 0.6950 and 0.7030 are the most important intraday boundaries to watch. Notice how the price is currently hovering near the lower end of the daily range as we enter UTC morning. The lack of immediate follow-through selling after reaching 0.6950 is a small silver lining for bulls. It suggests that buyers are stepping in to defend this multi-month support zone for the time being. However, momentum is still clearly favoring the downside until a significant resistance level is reclaimed. Volatility is expected to remain high as we approach several major central bank meetings next week. Don't chase the spikes, as they are often completely reversed by the very next news headline. Let's transition back to the daily view for our final recap and long-term predictions. To recap the key price levels for AUDUSD, keep a close eye on 0.6950 as our primary support. Below that, 0.6920 and 0.6835 are the next major stations for a potential liquidity flush. On the upside, bulls need to reclaim 0.7030 to neutralize the immediate bearish technical pressure. A break back above 0.7140 would be necessary to signal a true trend reversal and a return to bullishness. My unbiased prediction is that we will likely continue to trade within the 0.6950 to 0.7050 range short-term. I put the likelihood of a range-bound scenario at 60%, given the current geopolitical stalemate. There is a 30% chance of a bearish breakdown below 0.6900 if tensions in the Strait of Hormuz escalate. A bullish breakout towards 0.7200 only has a 10% probability without a confirmed ceasefire agreement. Long-term, I remain structurally bullish on the Aussie due to the RBA's commitment to fighting inflation. Once the geopolitical dust settles, the yield advantage of the AUD should attract carry trade investors back. Watch for the May RBA meeting as the next major fundamental catalyst for a definitive trend change. Also, keep an eye on upcoming U.S. jobless claims and consumer sentiment data later this week. These will provide clues on the Federal Reserve's potential path and the relative strength of the dollar. Trading in this environment requires strict risk management and extreme patience for the right setup. Wait for confirmation of a level holding before committing to a long-term directional trade. Thank you for watching Explain the Charts. We hope this analysis helps your trading strategy today. If you found this useful, please like the video and subscribe for more in-depth market updates. Remember to stay informed and watch the candles closely as new data points emerge. Finally, please note that this video is for educational purposes only and is not financial advice. Always do your own research before making investment decisions, as trading involves significant risk.